Options prices on volatile, high-flying stocks like Amazon are always extremely high compared to more calm and steady equities. I'm Seth Freiberg, the head trader of SMB Capital's options trading desk here in Manhattan. And experienced options trading professionals have a full understanding of why options prices are so high for volatile stocks, and more importantly, how to take advantage of those high prices in unique ways that are not as obvious to retail traders. In this video, we're going to give you a vivid example of just how profitable it can be to harness the power of high-priced options on Amazon. So stick around. I think you're going to find this interesting. Hi, I'm Seth Freiberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. In 2020, Amazon stock had an amazing run. At first, like the rest of the market, dropping in late February and early March, and then rebounding and ultimately soaring above 3,000, as you can see from this chart. Now, you'll notice that Amazon back in July seemed to find support at the $3,000 price area twice, and then began to rally after that. Now, those of you who watch our videos consistently might recall that last week we discussed the idea of selling put options on stocks at strike prices that we'd be happy to own those shares at. This week's lesson will involve some similar concepts, so I wanted to make sure that everyone watching is clear on how equity options work. And I realize that most of you probably know something about how options work, but just for a quick review, and this is going to be fast, what's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what the price of the stock is actually trading at any time before that option expires. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of his stock he owns at the strike price of that put, again, regardless of what price the stock is trading at any time before that option expires. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. So in the case of a call, even if the stock has gone way above the strike price of the call buyer can exercise his right to buy 100 shares at that strike price. In other words, he's entitled to buy the shares way below market. He could flip them the next minute and make a huge profit on those shares in that case. Or conversely, on the put option, even if the market goes way below the strike price of the put option, the buyer of that put option has the right to sell his shares of that stock at the strike price of the put that he's bought, even if the stock price has gone way below the strike price of the put, which effectively puts a floor on how much he can lose owning that stock. Now, on the other hand, at expiration, if you've sold a call and the market closes below the strike price of the call, then unless that call was previously exercised, the call expires worthless and the call seller just pockets the premium. Similarly, if you've sold a put and the market closes above the strike price of that put, then unless the put was previously exercised, it expires worthless and the call seller just pockets the premium. Okay, so now with that as background, let's suppose that a trader had reached the conclusion that Amazon would continue to find support at that $3,000 area and that there was a good chance that Amazon would retest that area in the upcoming months, as after all, we're in the middle of a pandemic, and at that time, a volatile presidential campaign was underway, and so occasional sell-offs would be likely. And as you can see, Amazon had rallied to 3,300 by mid-August, and so with that 3,000 support area in mind, let's suppose that a trader decides to sell Amazon put at that $3,000 support level, expiring a month out. Well, as you can see, the price of that put is $28.03, and we'll be breaking down the implications of his doing that in a minute. Now, before we get into how the rest of this trade plays out, I wanted to let you know that beyond what we're teaching you in this video, there are a large number of sound, viable, long-term techniques for trading options for income. And in that regard, we're currently running a 2-hour free intensive workshop where we'll be teaching you 3 of those strategies that real professional options traders use in that webinar. So we'll be teaching you a really simple but incredibly effective strategy that some of the greatest investors in the world use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. So if you'd like to learn these 3 strategies, then just go ahead and click the link that should be appearing now at the top right corner of your screen. That's going to open up a free registration page in a new window, so don't worry, you won't lose this video. Or you can register for the workshop at optionsclass.com. It's not often that retail traders can be taught strategies employed by actual Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Now, returning to this Amazon put that we sold, you can see that given that we sold it for $28.03, the cash that the trader receives is arrived at by multiplying that $28.03 by 100, because each option represents 100 shares of Amazon, and so the total cash received is actually $2,803. Now, moving forward to September 18th, the day that the put option expires, as you can see, Amazon sold off significantly down to $29.54. And so when a put option expires and the market is trading lower than the strike price of the option, as we mentioned before, then the owner of the put will naturally cash in on that put, as it forces you to pay him $3,000 for the shares when they're trading at $29.54. So at that point, you're marked down in your account because you paid $3,000 per share for each of these shares, but they're actually worth $29.54 at the moment. Okay, so now this is the interesting part. So you're sitting there with 100 shares of Amazon, and you got a choice. You can continue simply to follow your thesis that the shares will bounce and you'll make money as they pass 3,000 and continue upward. Or there's another choice, and that is to instead enter into what is known as a short straddle to take advantage of the very high premiums associated with stocks like Amazon. So let's see how this option strategy, the short straddle, would play out. A short straddle is a combination of a short put and a short call located at the same strike in the same expiration period. So in this case, the trader goes out 29 days to the October 16th expiration and sells the 3,000 put and the 3,000 call. And as you can see, the prices are very large. $165.60 for the 3,000 puts and $118.06 for a total of $283.66. Now again, you need to realize these prices all need to be multiplied by 100 because they represent the rights involving 100 shares of stock in each case. So as you can see from the calculation, selling the straddle brings in a significant amount of money, $28,366. So keep in mind that we've collected that premium as we move forward in this example. Okay, so now we'll move forward to October 16th, the day that this short straddle at 3,000 expires. And as you can see, during that month, Amazon had rallied, and by October 16th, it had closed at 32.72. So now what happened at that point is that the short put at 3,000, well, that one just expires worthless, and the trader pocketed that credit. But the short call, well, the guy who owned that call, your broker, would have assigned him those Amazon shares at a price of $3,000, and those shares would have left your account. Now, so let's analyze what's happened here from a cash flow standpoint. It's interesting. And as you can see, remember that we got cash in from selling that September put, which resulted in our receiving $28.30 in cash, as we mentioned. Resulting from selling that put, also, we were assigned the 100 shares of Amazon at $3,000 per share, which costs us $300,000. And remember, we sold that short straddle as soon as we were assigned those shares, which brought in $28,366, as we mentioned. And finally, we received $300,000 after our 100 Amazon shares were assigned to the guy who bought the call portion of that short straddle from us. So all that combined results in a $33,000 gain for us in a little bit less than 2 months, which is pretty solid. Now, before we wrap up, I'd like to make one further point. Let's take a look at simply being long Amazon shares from the day that we had sold that first Amazon put at 3,000 back in August. Well, on that day, the stock was trading at 33.07 when we sold that put. And on the day our shares were assigned back to the buyer of the call portion of the short straddle, the stock was trading at 32.72. So while Amazon stock dropped during that same period of time, we made a really solid gain by, instead of going long those shares, we took advantage of the options pricing by selling those options, thereby making a great profit while the stock went literally nowhere. So the takeaway here is that, like professional traders, if you can spot opportunities like this on volatile stocks like Amazon, you can actually make far more money selling the options related to those stocks than you can going long those same shares in a simple swing trade. Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it and would like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open up the free registration page in a new window so you don't lose this video, don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's really a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And please don't forget to click on the subscribe button right now so you won't miss all the free trading videos that we're posting constantly on our channel to help you to improve your game as an options trader.